Hey guys, David Robinson here. Welcome to the Apartment Investing Journey. I'm super excited about our guest today. He's a guy that I have seen and heard on other podcasts. I've been impressed, especially with the amount of success he's had in such a short period of time. And so I'm excited to dive into his story. We have Sam.rust with us today. Sam, how you doing?
I'm doing excellent, David. Thanks for having me on the show.
My pleasure. Well, a little bit about Sam. Sam is a lifelong learner. He is the founder of VGI Capital. Currently, Sam is the sole owner or managing partner of over 30 million worth of real estate, mostly in the Front Range of Colorado. Sam started investing in real estate in 2017, quickly moved to syndication, and is currently focused on growing VGI Capital into a leading real estate investment firm. So that's a very, very short snippet about your world, and I want to get a lot more detail. As I do with all my guests, if you don't mind, let's back up, and I just want to hear your story. You were born, and then what?
Yeah, born in Colorado. I've lived in the Rocky Mountains my entire life, so I think I'm about as far east as I ever want to go. Need mountains on a horizon. But really grew up in Boise, Idaho. Grew up on a family farm. My dad owned a family business that sold more industrial equipment, industrial automation. But my job during the summers was to run 40 acres of hay. And that was really where I learned how to work. I really enjoyed that, or most of that. Stacking a couple hundred tons every summer, 100-pound bale at a time was a great way to learn persistence and maybe some ingenuity and maybe some stick-to-itiveness as well. So that was my life. I was homeschooled growing up. I was the oldest of 8 kids. So we had there was a fair number of us running around the 40 acres. We really enjoyed the country lifestyle. But I'm really thankful to my parents for pushing me to really love learning. It was something that had a little bit of an aptitude for early on in life, and my parents cultivated that, but not with an idea for me to show off or things of that nature, but to really just be a good steward of what I've been blessed with, how God made me, and how can I go and maximize those gifts and talents for His glory. And so in that, the flexibility of homeschooling allowed me to take a little bit of a non-traditional path through college. I ended up graduating with a business degree at the age of 17. So got my bachelor's in business, and that kind of allowed me to have a jump start on life. I went into the workforce at basically 18 with a 4-year degree, started in industrial construction. Grew up with my wife. We started dating after I graduated college. She was in high school. We got married shortly thereafter. And then I moved to Salt Lake City to work for my dad's company, which was headquartered there. Again, industrial automation, B2B sales. So from there, worked in Salt Lake for a couple of years and then moved to Denver 5 years ago with my bride. We now have 4 daughters. So a lot of pink in my life. But about 3 years ago, well, 2 years ago actually now, was at a place where I've been blessed to be very successful in my sales role. I was in more business development at the time, had met my annual goal by June of one year, and had doubled it or nearly doubled it by July. And so had some capital at my disposal that I wanted to get to work, and hadn't really undertaken a learning project, so to speak, in quite some time. I've been focused on mastering my role in the business and growing into new role as a husband and a father. And was motivated with that capital. How can I be investing? How can I grow? And again, come back to stewardship for myself. How can I be a good steward of what I've been given? As I started surveying the landscape, listening to podcasts, reading books, real estate was something that I'd always been interested in. Most people are interested in investing in real estate, but that's a really broad swath. There's so many ways that you can make money, so many niches in real estate. It's incredible. So Googled top 10 investing podcasts. And there was several that were more stock market related, but came across Bigger Pockets. I think a lot of people of my generation have been introduced to the power of real estate through BP. Started listening to that, pretty quickly noticed a theme that everybody's favorite book in the famous 4 section is Rich Dad, Poor Dad. I'd actually read that book when I was a freshman in high school. And so I was somewhat familiar, but it had been a long time. And now that I'm an adult, I decided, I should probably reread this. So my wife and I were going on a trip to celebrate our 5th year anniversary. I read the book in a day. I was like, okay, I really need to focus on accumulating some assets, getting some cash flow happening in my life, and moving to the right side of the quadrant here. And really, for me, it came down to I want to get to a place in the long run where I cannot be trading time for money. I loved what I did at my father's company. Really enjoyed that. It was very flexible. I was compensated very well. But at the end of the day, I did need to be putting time into that business to make a return. And so started listening to Bigger Pockets, started exploring other real estate podcasts, and started noticing a theme among all those podcasts that syndicators would come on board, multifamily syndicators. And at the end, the host would ask them something to the effect of, what do you wish that you had done differently? And most of them had come up, started as fix and flippers, graduated to a duplex, so on and so forth. And every single one of them would say something to the effect of, I wish I'd gone bigger sooner. And I was like, man, that's a very interesting observation. They qualified that with saying, you need to know what you're doing. You need to invest in yourself and in your education. But it's definitely doable. And I didn't learn anything as a fix and flipper that I absolutely had to know before I started in multifamily. So multifamily in general as an asset class really made a lot of sense to me. The idea of really passive income. You're buying a business. The business is valued off of its income stream rather than an appraisal method. The long-term demographics of America really are a tailwind for multifamily, with more people becoming renters, either millennials or baby boomers. We're kind of growing in the rental market on both ends. Homeownership is more expensive. The tax benefits are phenomenal. And it's also got higher barriers to entry, which is something that appealed to me. There's a lot of people that do very well fix and flipping. I know several people, good friends of mine, that are very successful. It's not a very tax efficient way to make money, and it is a very rigorous job, unless you systematize it, of course. But even then, there's no way around the tax inefficiency. And so I, at the time, was not looking to transition careers. I was just wanting to find a place to invest my money, and figured with my background and my network that I could raise the money and then teach myself the underwriting and everything else that's required. And so was kind of gearing towards I guess it would have been December of 2017. And then my wife had the good fortune or the mistake, depending on your perspective, of giving me Grant Cardone's book, The 10X Rule. And the idea of massive action, it's not necessarily new, but it's something that Grant Cardone definitely has his fingerprints all over, at least in our milieu. And I just ate that book up. I read it Christmas Day. And by New Year's Day, I'm a big New Year's person. I love making resolutions and having goals that you actually work towards, whether it's on an annual or a quarterly basis. And I was like, you know what, honey? We're going to buy an apartment complex, Lord willing, in 2018. We're going to make this happen. And so not to skip too many details, but just started putting together a plan. How are we going to go from where we are now with a lot of desire and not a lot of knowledge, and how are we going to flesh that out? And so broke down the process into a lot of different steps. What do I need to do on a daily or weekly basis to make sure that we're progressing towards the end goal? And we were fortunate enough by March of 2018, so 3 months later, to have identified our first property. We put an offer in. We had to wait and be patient. The owner took 6 weeks to get back to us on our first full price offer. So it took a while, but by May we were under contract, and then we'd given the seller a couple of extensions to facilitate a 1031, so we didn't close until October of that year. But basically in 10 months went from a dream to seeing it realized, which was a tremendous blessing, honestly. Learned so much during that process, and then from there, it was pretty apparent from that point pretty early on that project was going to be a tremendous success. And so in December, around New Year's, we decided, we're going to try to do another one in 2019. Started looking, found one in January, went in negotiations, put it under contract in March, and then closed in June of this year on 180 units. So.
Wow. Now, you breezed through that and you did pretty good, about 10, 11 minutes. And I think people will get the sense that you're an impressive individual. You obviously have a great background. You've had a great upbringing. You're sharp. You get this. And I think what I'd like to do is dive into a little bit about you put together a specific plan that you wanted to execute on once you decided that this was important to you, that you saw this as a pathway for you. And I want to dive into a little bit more detail on that particular aspect of it, because I think there's a lot of people that are listening to our podcast and all the other podcasts out there. They may have just picked up Rich Dad Poor Dad. They may have just been exposed to podcasts on multifamily syndication. They're trying to come up with a plan, and I think that you could add a ton of value here. Do you mind maybe just breaking down from what you remember about that plan that you set in place, and what were the initial steps, and how would you guide someone else if you were coaching or mentoring them today on to do something similar to what you've done?
Yeah, I think that that's a great question. I really enjoy helping people get started. I mean, I'm still getting started. I by no means have this figured out. You know, I hope to be in this industry for a long, long time. And I guess to put a capstone on it, I ended up leaving my job at my family's company in August of this year, and am now doing syndication full time. So
congratulations.
thank you. I appreciate that. So to start out, I think, begin with the end in mind. And so we're assuming that we've decided that multifamily syndication is the path. There's a lot of other paths, but this was the one that I picked, and that a lot of people listening to your podcast probably will pick as well, or have picked. And right now, with the current climate that we're in, raising money tends to not be the limiting factor. The limiting factor tends to be, can you find a good deal? And so to find a good deal, you have to know what a good deal looks like. And so that pretty quickly became apparent to me. In my first deal, it was going to be friends and family. That's who I'm going to be raising money from. And that excited me on the one hand, because I really believed in the wealth building power of real estate. And I was excited to get to share that and be part of wealth building for my friends and family. There's also responsibility that comes with that. And so I needed to be able to be 100% confident in my numbers, and my grasp of concepts, to be able to sell that deal and be able to stand up in a room full of friends and family and ask for their money with a clean conscience. Not to mention talking to brokers and things of that nature. And so the very first thing I did was just start building my own underwriting tool. There's a lot of good underwriting tools that are out there. And I bought one after I completed my first transaction. But I learned so much by taking the formulas that I was listening to, that I'm reading in books, and putting them into an Excel format, and making the sheet do what I wanted to do, and double checking the math, and learning, okay, here's the importance of a revision cap rate. Here, if 0.5% makes a huge difference on rent increase on an annual basis. Are you assuming property taxes are going to be constant? All these different little things that, as you're building your own underwriting tool, as long as you're double and triple checking your work, you can see how one variable over here impacts the bottom line quite significantly. And so that was a great way for me to learn the terms, the formulas, and the math behind it. So I spent a good month just building the sheet and going to LoopNet, downloading offer memorandums, and trying to figure out, why is this deal on LoopNet? I was super green, but I had heard enough times that LoopNet is where good deals go to die. And that's generally true, by the way. I haven't found one good deal on LoopNet. I know people that do. I'm convinced it's the unicorn, though. It's a mythical beast. But it was a great practice field, because I know that the deals I'm looking at are not good. Well, why are they not good? And then my mind would take the next step. Okay, we figured out why it's not a good deal. What would make it a good deal? Maybe is there an alternative strategy, even though I'm focused on, at the time, 50 units plus, wanted to achieve some scale right away. If I was underwriting a 24 unit, like, could you Airbnb this? And just trying to train my mind to be creative in how we're looking at deals, which ended up being pivotal in the next step of the process, which is talking to brokers. There's a lot of people out there that do direct mail, particularly in the fix and flip game, and that works well there. There's other folks in the multifamily game that also do direct mail. In my market, that was not going to work, particularly for properties of scale. And really, I think for anybody that wants properties over 50 doors in a complex and where the cost per door is over 100,000 a door, when those two conditions are true, 90 to 95% of the deals are going to be controlled by the brokers. It's just the fact that's what those guys do. They live and breathe that world. They spend way more time at it than you and I ever could. And so I needed to be taken seriously by brokers. You know, I'm fairly young, and not the most imposing figure. And so really my in was going to be, I had to be able to speak the language. I had to be very precise in what I was asking for from brokers, had to give them in a very quick fashion, you know, the sense that I knew what I was talking about and that I was focused on what I wanted. And so I started, you know, looking at brokerage houses based on who was the most active on LoopNet. I figured let's just start there, and I would Google them. And this is maybe one of the more actionable tips, but I just started looking for brokers that were younger, but maybe had won an award or two. Figuring that those guys are trying to grow their business, they're proactive. You've weeded out a couple of those guys that maybe didn't make it through the first year, that didn't survive the lean times at the front end, but they're still hungry. They're of my generation, and they'd be willing to take a risk on somebody like me. And that ended up paying dividends. There was a particular broker that started sending me some deals, exactly what I didn't want. The conversation, you say, you know, hey, Sam, what are you looking for? I tell him, Mike, I need, 50 doors and up, C class with a value add component somewhere in Colorado Springs, which was a market that I'd identified. And I'd get a 10 unit new build in Georgetown, which is a resort town up in the mountains. But it was that Georgetown deal that actually turned the corner in our relationship, because I took that deal as like, obviously wasn't what I was looking for, but rather than just tell him, hey, this isn't what I'm looking for, I thought, you know what, I wonder if you could Airbnb these units. And so I called the city and figured out, you know, could you? And it turns out that you could Airbnb 4 of the 10. They had some restrictions on that specific zip code, and even those cross streets, there was limitations on how many you could Airbnb. So I wrote the broker back and I just said, hey, you know, I'm not interested, but I did look and see if this could maybe be an Airbnb model. And here's what I found. And if you want to talk to these people, here's their contact information. And that really changed how that broker viewed me, because he thought, this guy is taking some initiative. He knew that he was sending me stuff that wasn't what I was looking for, but I'm not just pitching it aside. I'm taking a little bit of initiative, and I'm providing some value to him, probably most important. And so, you know, it wasn't maybe 4 weeks later that he sent me an OM on this deal that had been on the market for 6 months. And, you know, it was at that point that I started worrying about, well, how do I write an offer and things of that nature. I figured, you know, I don't need to know how to write an offer yet. I can learn that pretty quickly. That's not a very complex process. You know, let's focus on learning how to underwrite real deals now. Let's focus on broker contact. So, you know, from there, it kind of the progression from negotiating a deal to due diligence to cost segregation studies, you know, and then operating a deal, just really not getting ahead of myself as best as I could, learning enough about it so I didn't get in trouble, but also being comfortable to learn as the process took me to those places.
Man, what an interesting way to go about it. And I think you're pretty unique in that regard. I think most people will want to know the end from the beginning and know all the detail about every step of the process to feel confident to be able to execute on a deal before they actually go and spend the time, developing their own tool to analyze deals. B, starting having those broker relationships. So that's, I think that's unique. And I think it's, I think it's very telling. It's actually, I think something that people can really learn from, to not get caught up on every single step of the way, but to really focus on the task at hand. What do I need to know now today to be able to move things forward and get closer to my goal? So I am curious, though, in that regard, what do you feel like gave you the confidence to approach it from that perspective? I would say that's unique. I don't think people feel confident to be able to go about it that way. What gave you the confidence to be able to do that?
That's a good question. Some of it may have been naivete. I think by upbringing, my parents were intentional to not instill pride, to try to cut that off at the knees, but also to raise their kids in a way that they were confident and capable. And I think for me, it really came down to, I was confident in my ability to learn whatever I needed to learn at that, for the next step. With with my college journey being a little bit atypical and some other things, that's just, I'm very used to being in maybe unfamiliar or even uncomfortable situations, and really imperfectly trying to push myself and expand my horizons, and see how far I could go, while at the same time, holding true the fiduciary duty to my future investors or to my investors once I had them, that, hey, I really do know what I'm doing and you can trust me with your funds. That's, so there's a chicken and an egg component there. But I think really just believing that, God had placed me in those situations, that he'd given me the tools I needed, and that if I was being a good steward of those gifts, that that doors would continue to open.
Love it. Yeah, thank you. So I'm interested in the next step in that process. You obviously got the deal under contract. It took you some time. For the sake of time, I don't, because I do want to dive into your 180 unit deal. I don't want to get hung up too deep on the details of your first deal, but I am interested in hearing more about your experience in raising the capital to take down that first deal. And what was that aspect like for you? Obviously, your first foray into raising capital. What was that like?
Yeah, so the first thing I did was I was able to convince my father-in-law and an uncle to come on board and act as key principals. And so they lent their name to the project. They invested some sums, and it was kind of the triumvirate. But I was the one with the boots on the ground. Found the deal, was going to do the money raising. But it gave some legitimacy to the whole thing. It wasn't just one guy trying to stand it up on his own. Neither my uncle or my father-in-law had prior experience in that business, but they had some real estate background. One was an agent, and one had done some self-storage development. So that was helpful. I didn't go through any mentoring programs. I think those are great. That's a whole nother topic. But I think you do have to have some gray hair or some experience or wisdom on your team if you're going to make it happen. And that was the way that I chose to do it, was to share the deal, so to speak. And then we went out and recorded a YouTube video that we locked. We did a 506B style offering. And we locked the video so we could comply with that, so we weren't broadly advertising. We filmed it on site. We had a professional filmmaker come out and film my uncle and I walking through the property, talking about the returns, the risks. We were raising funds from people who didn't know really the first thing about multifamily in a lot of cases. And so we had to educate them and then convince them to invest, which is a little bit of a different hurdle. And that worked phenomenal. That first raise, we were raising 2.1 million and we got it in 10 days.
Wow. Very impressive. And what would you say was the biggest factor to that? Was it the credibility that your partners brought to the table? Was it the way that you presented the deal? Had you, I assume that the vast majority of these, or at least what you said, was that the vast majority of your investors were friends and family, people that you had a prior relationship with. But had you started developing relationships with other potential passive investors outside of friends and family prior to, getting this deal under contract? Was that anything that you'd spent time on?
No, it wasn't. There's a lot of people that tell you need to develop a thought leadership platform, and I completely agree. If you're going to really get into this business, or you need to partner with people who do. I was blessed to have enough people in my natural networks, whether it was past business acquaintances, people I grew up with, things of that nature, that I felt confident in my ability to at least do that first deal without needing to go to that step. And I wanted to stay hyper-focused on finding a good deal. And so I didn't go the traditional route in that sense. I also didn't have commitments before we placed the property under contract. That's a tricky one. There's a lot of people that will tell newbies not to do it that way. I think that it all is just being honest with yourself. Do I have the network? Do I project the confidence? Do I have the ability to engender confidence in other people and make them feel comfortable in investing in my project, even if it's my first one? I felt confident in my ability to do that, and had a couple of partners there to help with that process. And so we were comfortable taking that risk. I think that's a very case-by-case basis, though. I think overall it was really people knew me. We had like 13 investors on that first deal. They knew me. They had observed my character. And I think that's probably the biggest thing that people invest in is somebody, the sponsor himself rather than the deal. Yes, the deal has to meet those parameters, but people want to know that they can trust you with their money. In a lot of cases, it's, they've spent 30, 40 years accumulating this nest egg. They're not just going to hand it to anybody. They want to know you personally.
Yeah, love it. Thanks for giving us some more detail about that. So I really would like to take this conversation even longer than we discussed before we started recording, because I'm just totally intrigued by your story and your process and your thinking. But I do want to dive into the 180 units. So I want to shift gears a little bit here.
Sure.
And let's talk about, so not your first deal. Your first deal you took down was a 64 unit. And then the second deal, not too long after you had closed on that one, you took down a 180 unit C-class value add in Colorado Springs. So if you can, maybe set the stage for us. Just give us a brief description of the asset itself.
Yeah, so the asset, very classic workforce housing, built in the 1970s. It's in Colorado Springs, like you mentioned, which is a market that's about an hour and a half away from where I live. It's where our first asset was. It was in a different section of town. But we had the property management team all lined up. We had a lot of things in place from our first deal, so felt confident in that market as a whole and in our ability to execute the plan again. So it's on a main thoroughfare. It's got great visibility. It's in an area of town that has turned the corner maybe in the last 10 years, or maybe is turning the corner. It's not the hood of Colorado Springs, but it used to be. And so there's some good things about that. You're in the path of progress. There's growth. There's a lot of redevelopment. There's also maybe some risk to, we're not the first people to the area, but we're also not the last. There's not a guaranteed business plan. We are stepping forward a little bit. The asset itself, though, was owned by a group that had a lot of their money from Israel, and the Israeli partners did not really understand how multifamily worked, and they were managing for occupancy. This property, when I first took a look at it, was literally 100% occupied. And if you ever see that, that's a really good sign that the person either doesn't know what they're doing or is managing for the wrong criteria, because you want the property to be about 95 to 97% full. If you're 100% full, it means based on simple laws of supply and demand that you're not charging enough. And that's what was happening here. We went in and did a market survey. I did one myself. I asked my property management team to do one. We compared numbers. We actually came up, I think we were within $5 on our average, which was encouraging to me that I was doing my process right. And we figured that they were under market by about 20%, which nicely fit our criteria. And we were looking for properties that were at least 15% under market to go and make an offer on them. We found the deal through actually the broker that I closed that first transaction with. He had competed for the listing, had all the inside information, didn't get the listing, but as soon as he found out he didn't get it, he took all that information and gave it to me. And so I was able to do a full underwriting, all my due diligence before putting an offer in, before the property ever made it to market. And we actually submitted an offer 2 weeks before they went public. They ended up going public to the market, but we were able to agree on a PSA a week after they took it out. So they didn't go through their full process. They didn't go through call for offers. The owner here in the States was anxious to dissolve this partnership. Time was of the essence. The market told him that we'd given him a very fair offer, and we were able to get it signed pretty quickly. So, that's how a newbie still, really wet behind the ears, was able to get into a $20 million deal. Right timing. The broker that I'd worked with knew that I was somebody who could close, and he wanted his piece of the action. And so we ended up having to pay that broker, a 1% fee. It's the best $200,000 I've ever spent in my life, because it's going to make me millions, or make me and my investors millions, multi-millions. And so I think there's something that I took away from that is just don't be afraid to pay people what they're worth. And he was worth every penny of what we paid him, just by giving us access to that deal.
Yeah, that broker relationship is paying off, that's for sure. Tell us a little bit about the deal structure and the financing on it, if you're okay with diving into that.
Yeah, definitely. So the way we sold that deal to our investors was about 109% overall return over a 5-year period. We were doing an 8% preferred return, paid out quarterly. Starting immediately, we just paid out our first quarterly dividend 2 months ago. We're getting ready for our second payment. And so the IRR was, roughly 19.5%, somewhere in that range. So a really solid project, really fitting the axiom of, hey, we're going to double your money in 5 years. Now, we're not promising that. Every time I say that, I just, it's almost a reflexive habit now. We're not guaranteeing anything, but according to our conservative projections, we believe, based on all these factors, and you give the investor the story, this is why we're comfortable modeling that, and why I'm comfortable standing here before you and telling you I believe that you will do X, Y, or Z with your dollars. So financing, we went with an agency loan. We went through Fannie Mae. There's actually an interesting story on that. We had hoped to be able to have all our funding in and be able to close in May. It would have been like May 20th, I think, was our original closing date. But we had a 30-day extension. It became obvious about 2 weeks beforehand that we weren't going to have all of our funds in. So like, let's go ahead and use the 30-day extension. We had to give them 2 weeks notice. So we went ahead and did that. And just by providence, we got the last investor came in, committed a 7-figure sum on May 20th. And then by delaying, we had originally underwrote our loan terms to a 4.25% interest, but the 10-year treasury took a dive right after we did the extension. When we ended up locking, we locked it at 3.83. So we saved, to put that in context, our overall investor payout in year one is supposed to be $540,000. That's the 8% preferred return. We saved in interest alone by locking a month later, $50,000 in interest a year. So we made 10% of our investor return by, basically waiting a month to close our loan terms. So it was fantastic. You want to be both lucky or blessed and good. And I think we were fortunate enough to have that be the case on that deal.
I'm curious, after the 8% preferred, what kind of split do you have with your investors?
I should have mentioned that. Yeah, 70-30 split.
Cool.
Yep, right. 70-30 split.
Excellent. So talk to us a little bit about the business plan. What was it about this deal? I know that, well, actually you did touch on that a little bit. Yeah, the occupancy was at 100%. You saw an opportunity there, you're about 20% below market. What was the business plan moving forward?
So we took over the property in the middle of June, which is right in the middle of leasing season for most places in the country. That's definitely true here in the Springs. We had been updating our market surveys monthly. And the market in Colorado Springs has been moving with extreme velocity. They've seen, I think it's 7 years in a row of 5% or more annual rent increases. So it's just phenomenal rent growth, which gives us an opportunity to go find properties that maybe haven't been keeping up. But with this property, we decided as soon as we took over the keys, let's see what we can push the rents to without renovating. So the 20% bump, we had planned on renovating the units. So we had a renovation budget. We were planning on doing that. But the property was half 2 bedrooms, half 1 bedrooms. And in Colorado Springs, like most markets, the 1 bedrooms tend to be a little bit harder to fill. People are more, gravitate more towards the 2 bedrooms just for a little bit more space. And so we figured, let's start our renovation plan and let's totally trick out a 1 bedroom. Let's do more than we had planned to do and just see what happens. And I think on a 1 bedroom, we had planned to push the rent from like $675 to $825, just to use some round figures. So that, roughly a 20% jump. We completed our first renovation 3 weeks into the property, into owning the property, and we got $995 for a renovated unit. And we were getting $925 for unrenovated units. And so we were getting basically 15 to 20%, depending on the exact unit type, more than our pro forma without ever doing anything to them. Wow. Which obviously is phenomenal. And not really a function of us executing on a business plan other than let's invest in a growing market. We really want to invest in markets where there is good growth so that we can have cash flow. We want to invest in deals that have cash flow, but the majority of the reward is going to come from appreciation. And so, we pretty quickly started renovating a bunch of the 1-bedrooms. We carried that renovation plan through September, and then we focused on occupancy. So we stopped doing any renovations on any units in the latter part of September, focused on maintaining our occupancy going into winter. We've had our occupancy dip a little bit lower than we would like. It's right about where we'd planned it, in the high 80s, as we turn over some tenants that, just aren't paying on time, or various issues of that sort. But we're on the track to get back to 95% by Thanksgiving, all things coming together. Maintain it through the winter, and then when we hit leasing season again in April, probably going to back up 4 weeks and start renovating units again in March. And focus on driving value and be ready to turn over, or at least offer our tenants, quite a few amenities. We've updated the clubhouse. We put in a new roof on everything, new windows on everything. We're updating a lot of the common areas. Really trying to spruce the place up and give people a really clean place to live that they can be proud of.
Oh, that's great. I was curious if you ended up using the same property management team on your on this second acquisition as you did on the first one.
We did, yeah.
Okay.
So they had stepped down, so to speak, a little bit to take the 64 unit. The broker put in a good word for me and told the owner of the property management firm, it was the second largest in Colorado Springs, hey, I think you'll like this guy. He's a good guy to work with, and take a chance on him. So they did, and we've loved working with them. We've definitely, you want to maintain a level of accountability there. That's really important. We have weekly meetings. I'm down there fairly regularly. But all things considered, just thrilled with the partnership we have. They deserve every bit of what they charge us, that's for sure.
Yeah, I bet. All right. Well, you have given us a ton of detail. I have loved your story, and we've got to start winding down here because I want to be respectful of your time. But I've got 3 questions I want to ask you, and I just want to get your sort of knee-jerk gut reaction to. You okay with that?
That sounds great.
Okay. What's the biggest mistake you've made on your apartment investing journey so far that you feel like we could learn from?
That's an easy one. I made a big insurance mistake on our second deal. The property I knew had an outstanding hail claim on it. There's a long story there. We got assigned the hail claim, and it all worked out. But what I didn't realize was that when you have a loss, what's known as loss runs in the insurance industry, that really affects your premium. I thought naively, and not having researched it, that if there was a new roof on the property, insurance would look at it somewhat favorably and the insurance wouldn't change all that much. Not so. I covered myself a little bit by going out and talking to 2 different brokers who got me quotes based on rough numbers when we first went under contract. Fast forward 30 days, we're getting ready to lock, and all of a sudden the insurance premium went from $50,000 to $130,000. Huge delta. $80,000 a year is obviously significant. That's like 15% of our overall return that we need to give to investors, but it had a dramatic effect on our loan outcome, and how much of a loan to value we were going to be able to pull. And so we went back and we pulled every lever we could. We got some waivers from Fannie on a couple of deductibles so we could go with a higher deductible plan, show them that we were going to escrow the funds so that we would have it for the deductible if we needed it. And ended up talking them down to around $75,000. So we were able to shave quite a bit off of the original 125. But that was probably the most stressed out I got in the whole process. Honestly, was trying to figure out, how can we recoup back basically $1 million in loan proceeds that were lost. The Treasury moving in the right direction helped us out a lot, but definitely find yourself a good insurance broker, and note that whenever there's loss runs on a property, that's a question I ask now routinely. Has there been a loss run in the last 5 years? You can count on the insurance, if they haven't renewed the policy since then, jumping often by double.
Wow, that's a great tip. Thank you. All right, what's the biggest win you've had on your apartment investing journey so far?
Starting. No, we haven't taken anything full circle yet. So I'm very excited to do that. Our first deal was a 5-year hold. We told investors we're going to double your money in 5, or we'll hold it for 10 years and triple it. Those were kind of the 2 paths that we told people we would take. We're finishing out our value add program now. We're going to go into leasing season. We're going to have a clean T12. And it looks like we're planning to sell this summer, which will be our biggest one, and provide somewhere between an 80 to 100% return in about 18 to 20 months. So it's not going to be quite as big an overall return, but our investors are going to be thrilled that we get them back their original capital plus 80% in 18 months. Not a lot of places you can do that. So again, that's counting some eggs, but
Sure.
I think the outline of the chick is in there.
That's awesome. Great. All right. Last question for you. What's the best advice that you have for someone who's just starting their apartment investing journey?
Best advice. We talked about this earlier, David, but I think having a plan. Where do you want to go? Where do you want to go? And then just work backwards. The people that start in this business and make it to the Joe Fairlesses of the world that get to $500 million in 5 years or less, they got there by systematizing things and identifying a goal and then working backwards. I've done that imperfectly. There's areas I'm constantly looking to improve, but recognize that you're not a finished product, and just think, what can I do today? Whether that's listening to a podcast episode, it's memorizing one of the formulas, it's putting in a little bit more time on your own analyzer or someone else's analyzer, or calling 2 brokers. There's steps that need to happen on a day-to-day basis that add up to huge changes. So have a plan and make it actionable on a day-by-day basis.
Love it. Well, Sam, you have been a phenomenal guest. I appreciate all the detail. I appreciate you going into your story, your upbringing, and how you've taken down these 2 deals that have been very successful in their own right. And I just appreciate you taking time to share your short journey, but with great success so far, with great things ahead of you. So thank you for taking the time. Appreciate it.
Thank you. I really enjoyed our time together.
All right. Well, we'll talk to you soon. And thanks everybody for listening today. And we'll catch you next week.